Thank you very much for the introduction, for also including the paper in the program. This is joint work with Simon, who I actually presented earlier this morning as well. So from the title, you can see the title is essentially CBDC. So CBDC is going to be prominently featured, but it's not restricted to CBDC. And we say it's coming battle. I think it was coming earlier, but over the past few weeks, maybe things have changed, but it's still maybe coming in a few months or in a few years. So where do we start? Forget about tokens or digital currencies or cryptocurrencies for a moment. I think we've seen quite a few decades of digitization overall. The demand for peer-to-peer interaction within digital networks, the demand for on-demand and gig economy, where people come, it's plug-and-play type of even labor market going on. So what we really need is a functional system. Does it have to be tokens? Well, that's to be debated. But within this system, what have been potential candidates? Well, we've seen the rise of private payment system or digital payment systems, right? That's one general trend that has been going on for a few decades. More recently, we've seen a more decentralized solution through blockchain technology. And I'm happy to chat more about that, but that's not the main focus. I think it's safe to say that not all crypto tokens are created equal. They are actually serving very different economic functions. And stablecoin or CBDC would fall into the category of general payment tokens. These are tokens that are kind of competing with fiat or money in a very general sense. There are other tokens, for example, NFT, non-fungible token. It's not used as a means of payment, right? So there are other issues going on, but that's what we're going to focus on. Speaking of CBDCs and stablecoins, there's a large academic literature from both academic institutions and central banks. I don't have to explain that part too much with this audience. I think you're already very familiar with that. And of course, I'm based in the US, so President Biden has an executive order that specifically mentioned digital currencies, right, in this setting. Now, if we look at the global stage, various central banks, governments have been experimenting with introducing central bank digital currencies. I would say the literature thus far has been focusing on specific designs of CBDCs and how they interact with the banking sector, for example. What we want to do is to complement that literature, to think about, in terms of global currency competition, how do we think about the strategic actions and reactions when we talk about digitization of money? And when we also observe the rise of the cryptocurrency market, right, on the side. To me, cryptocurrencies, or at least many blockchain projects, can be viewed as almost like a cyber country with their own local means of payment. So a number of questions we hope to start exploring, right? How does the emergence of cryptocurrencies affect fiat currency competition? What are the incentives for different countries to introduce their digital currencies? And how do they respond to the introduction of digital currencies by other countries? And how would this all interact, again, with the crypto sector? Okay, so, of course, we've been talking about stable coins earlier this morning. We're going to, in a very reduced form, model stable coins, but it's not going to be the main focus. So in terms of how we want to add to the literature, I think the main contribution is really want to offer a initial game theoretical analysis of the digitization of money in general, against the backdrop of the growth and decline, the evolution of crypto sector. We believe it can help rationalize some of the events and actions that we've been observing, and there's a number of future implications from the study. So a very quick view of what we find. First, without cryptocurrency or digital currencies, just in terms of currency competition, we want to have a sanity check. There's going to be a feedback effect through the strength of currency. Basically, the strength of currency and the strength of the economy of a country is going to have a feedback effect. So that's often referred to vicious circle of inflation and depreciation, so on and so forth. Dollarization, the stronger currency is going to have dollarization on the weaker currency. So that's there. That's good to see. It is indeed there. What digital payments or cryptocurrencies in general introduce would be a buffer zone in the middle of the battle between fiat currencies. And it turns out that it's going to have different impacts on the stronger versus the weaker fiat currency, which will make more explicit. So essentially, the rise of cryptocurrencies can typically hurts the stronger currency, but it could benefit the weaker currency because it's reducing the competition from the stronger currency on the weaker currency by coming in the middle and entering this buffer zone. We also find there is a pecking order in terms of the incentives to introduce CBDCs, so to digitize money further. Now the model, we can't overclaim, right? The model is about introducing digital currencies, but more generally you can think about even further digitizing the payment rail or the banking sector, something like that. The pecking order goes as follows. The non-dominant currency, which is not too weak, but weaker than the most dominant currencies, actually have the highest incentives to introduce CBDCs in response to cryptocurrencies and also in response to the potential introduction of digital currencies by other countries. The most dominant country actually is the second in line in terms of the strength of the incentives to introduce cryptocurrencies. And their goal is to either nip the growth of the crypto sector in the bud or to respond almost like a defensive measure to other countries' digitization. And finally, the small open economies, the very weak countries, well, I shouldn't say the country is weak, the countries with the weakest currencies, they have the least incentive. And sometimes they are better off adopting a cryptocurrency or stable coin in that sense, as long as that stable coin is not only pegged to the strongest currency. We draw a few implications about digitization in the long run. For example, the rise of cryptocurrencies might help the weaker currency in the short run, but in the very long run, it's going to lead to more digitization of money, and as soon as the stronger currency becomes more digitized, there could be even stronger, let's say, digital dollarization. So in the long run, it could still be hurt. If we view the evolution of the crypto sector as financial innovation, this is definitely tied to incentives about financial innovation. There's a number of additional results we probably wouldn't have time to cover during the presentation, but there's a way to think about stable coins. If we require the stable coins to hold the reserve of certain fiat currency. So that's a way to tie it to the supply and valuation of various currencies in the model. Okay, so I'm going to skip the literature mostly, but it's definitely related to currency competition in general, blockchains and cryptocurrencies, as well as discussions on CBDCs, which is a huge literature. So here's the model. We used to include a two-period model for illustration, but I'm just going to present the latest version with the full dynamic model. So time is discrete in small increments dt. Towards the end, we're going to take limit dt going to 0 so that we get a continuous time limit. There's a representative household or overlapping generation, which could be further micro-founded, thinking about people lying on a line segment and hoteling model, having different preference for different currencies. But it's going to be equivalent to this representative household. The household is endowed with 1 unit of consumption numeraire, and each cohort lives from t to t plus dt without time discounting during that small in the model. They derive utility only towards the end of the lifetime. So they need to figure out a way to carry the perishable consumption goods towards the end of the period. And money, in that sense, is going to serve as a store of value. But we're going to model all three functions for money in a sense, right? So we have to specify the supply of currencies within the model. We have two countries, A and B, that are supplying their own fiat currency, at least in the baseline. And there's a crypto sector, C. We're just going to talk about one representative cryptocurrency, also denoted by C. In terms of the consumption goods value, we use PX to denote their valuation. We fix the supply to be a unit supply for each during each DT. It can be renormalized. With money neutrality, you can map that into, for example, interest-paying currencies as well. But here we're just going to focus on the valuation change over that small time interval DT. Currency A, without loss of generality, we're going to say currency A is the weakly stronger currency. It could be US dollar, euros, depending on what is the currency B that we're talking about. Currency B could be, RMB, rupees, Canadian dollars, Australian dollars, and representative cryptocurrency could be a stable coin, but it doesn't have to be. We're going to talk about the process of that crypto sector. But before we introduce any crypto sector or digital currencies, we have to talk about some of the differences between the fiat AB and cryptocurrency C, right? So for fiat currency, basically, within each country, there is going to be a tax raised to cover fiscal expenses, to service the country's debt, so on and so forth. During that small interval DT, there's going to be a tax amount that could be a sum of what is in the consumption numeraire plus an amount that's in units of the stronger currency A. So what we have in mind is, well, if A is the stronger currency and it is the reserve currency, we do know in practice they are usually used for invoicing, they are used for denominating securities that's held internationally. In fact, I think US dollars still represent over 70, at least 60% of international cross-country security holdings. So we want to capture that, but in general, there's going to be a kind of inflation tax. And from that, you can already see depreciation of currency X with respect to the consumption goods and the inflation or the fiscal cost of the country does have a positive association. In a dynamic setting, it's going to.
I understood nothing at all. T, what is tau? Tau is the spendings, the public spendings?
Tau is the represented household's expense for in terms of tax. It's just paid out for infrastructure or.
That's the public spending.
Yes.
In country X.
In country X. Yes.
And I think so. You're saying that to pay for the public spending.
Yeah. There's a capital amount that's denominated in the numeraire, right? There's consumption goods that people surrender. That's first element. Second element is it's a constant pi x times the price of currency A. Basically, that payment is denominated in units of the reserve currency. That's why we have that.
So the French government needs to buy dollars to pay for hospitals.
Or if the French government issues debts denominated in US dollar, and they have to pay the interest in US dollar, then that's what this would correspond to. A certain invoice. Yeah, oil in US dollar.
But it's not the government that buys oil; it's the companies.
Sure. So.
But they're not. I thought it's an inflation tax in terms of your own currency, and the amount of expenses happens to satisfy this formula by construction.
Yes.
So it's not that the country B needs country A currency. They're just looking at the currency, and they just look at the country A price level to determine how much spending they want to do. Right?
Yeah.
For some reason, the price level is really high in country A. If the price level in the US, let's say that's reserve currency, is really high, then France would decide they really want to have lots of public expenditures. That's what the formula says. And the financing this public expenditure using the inflation tax, so there's inflation dynamics on the French currency or the euro currency that would follow from that expenditure. I mean, that's how we read that sentence, but maybe that's not what you meant.
I think that's captured in the expression. Well, we're not imposing that this pi has to be positive. It's just if some payments are already agreed to be paid in that. What we want to capture here, and also in general, is the unit of account function of the currency. The stronger currency, being a reserve, global reserve, has a unit of account function. And whether a currency is a reserve currency in the model is endogenous, in the sense that starting off, if the valuation of currency A is higher, and in the long run it stays as the more valuable currency, it's going to be defined as reserve currency in the setting.
And where is inflation? I did not understand how this is inflation.
So if we can just hold out for a few slides, maybe once we see the expression, it's a little bit easier. Yes.
Why inflation tax? Why not income tax? Consumption tax. What's so special about inflation?
Great question. So we use inflation as one example. It doesn't have to be all about inflation. It reflects some cost that's going to be affected by the reserve currency or the unit of account we use.
I guess what you're saying is country B has some level of inflation.
Yeah.
And inflation generates inflation taxes for the government.
Right. So forget.
And the
Yeah.
amount of inflation taxes. I mean, there could be some other taxes.
Right. Yeah.
But the inflation itself generates an inflation tax.
Yes.
And that's the amount. Or it's an inflation. Actually, it doesn't generate. It doesn't. So the inflation tax is, I mean, it's done by seigniorage, by money printing.
Yes. Yes.
That's
So
how it generates revenue for the government,
right.
and it results in inflation.
yes. So forget about the second term for a moment. First term, every country might be collecting some tax, right? A certain form of inflation to pay for their fiscal expense. It could be, I guess it could also be non-inflation related. Well, it's going to show up as inflation in the model. The second term, if I have to give an example, would be suppose U.S. is issuing a lot of debt, or other countries are using U.S. dollar to denote their contracts. When U.S. inflate their economy, that's going to affect other countries' inflation as well. That's essentially capturing this spillover from the reserve currency a bit more. Yes, Linda.
So for country A, you would also have, for country A is the pi then zero? The equation for country A?
Not necessarily.
You have the PTV then? So do you have
No, for country A it's PA, for country B it's also PA. It's just the unit of account for international invoicing, for example.
Maybe another normalization question here. You would think that inflation would lead to PTA rising, let's say, exponentially over time, like with constant inflation. So that would say that the government spending would also rise exponentially in terms of consumption goods. I mean, it's sort of unusual, right, to tie the rise and the exponential rise in nominal price level, which, I mean, I don't know what the price, which is just real, right, to something real here now.
Yeah.
I mean, you could have put the inflation rate. I mean, you are
Right,
arguing
yeah.
about the inflation spillover.
Yeah.
I get that, but
Yeah.
then why not have the inflation rate rather than the price level on the right hand side?
Sure. So, for a moment, we can ignore this term. We can set it to zero. The effects would go through, but we do want to just capture this effect that when U.S. is printing more money, And because US dollar is used as unit of account globally, other countries do get affected. And that's a simple form that we think can capture that effect. But we have to think more how to map to specific channels there. Okay, so each cohort of representative household is going to allocate their initial consumption good allocation across the three currencies. Right? C is the cryptocurrency that I'll talk about in a little bit. These are all in numeric terms. And because my endowment is unit, so they have to add up, right? So money as a medium, so that's money as a store of value, right, on the earlier slide. Money as a medium of exchange is modeled through a convenience flow when holding particular currencies. And we do set some technical regularity conditions so that, if I live in the US as a citizen or permanent resident, holding US dollar, at least does give me some greater consumption. So it's not fully compatible or substitutable in that regard. So household utility, the represented household utility is their consumption plus this convenience flow that's coming from holding currency A, currency B, and cryptocurrencies, depending on their allocation. And the equilibrium consumption is whatever, by the end of the period, whatever I get minus the tax that I'm paying.
So that's the tau is the inflation?
Yes.
So I had one, and then
I lose a fraction.
One,
Yeah.
and when I'm old, I have less than one because I have lost the inflation?
Yeah. Yes, exactly. Yeah. Because maybe the money is used for some infrastructure that the citizens get. And the benefit, of course, for paying for infrastructure could be captured by this convenience flow, right? Holding that currency gives me some convenience flow. Okay, so the crypto sector is endogenously evolving. So essentially, you can view this Y as a kind of productivity multiplier. It's evolving over time, and the more people allocate to that cyberspace or crypto sector, the faster it grows. Does it have to follow this dynamic process? No, we can specify something different. And you don't have to view our figures as time evolution. It's essentially a map between the strengths of the crypto sector to some outcome in the economy, right, in general. If it's declining, then we just need to look backward to think about it.
What is strength in crypto?
It could be how productive a certain crypto payment system is, how many innovative use people are introducing to that system. So the more wows, the more kind of attention that comes with the allocation, potentially the applications are growing faster.
So behind these are applications that apply to crypto as opposed to other things, and they are
Yes.
enhance what? Consumption, happiness?
It enhances the convenience flow we get.
So you're just saying the network effect happens. Currency is more used, that's all you're saying, right?
In a dynamic sense, right? Like,
But help me here, like way back when we had the barter system, when we
Yeah.
was all pegged to the gold.
yeah,
So all these things were working then because it was pegged to the gold and we didn't print more.
yeah.
And then we went through all that and we are reintroducing the old, new, and a new model. Is that fair to say? Like stable coins, the old times.
Yeah.
It was the dollar,
That-
when it was all pegged to the gold, right?
Right.
It was a real indicator of economic progress.
Yeah.
You could measure that. Then we let go of all that. And now we are creating a stable coin and some artificial stuff, which takes us back to the old days. I'm saying it right.
I think we can apply this to that setting as well. I don't have too much to say about the earlier literature due to my.
Maybe let's keep now all the question at the
Yeah.
end since time is passing.
Okay, let me just show you some more results there. Okay, we do require market clearing for currency X, and if we want to model stable coin, we can model a fraction of the stable coin. Suppose the stable coin is pegged to currency a fraction of the reserve has to be held, right? That also boosts demand for the underlying fiat currency A in that regard. If it's a basket, if it's pegged to a basket, has to be the platform has to be holding the reserve from a mix of the underlying currencies. So individual households are just going to solve their optimal allocation problem. Equilibrium condition is the marginal kind of payoff from holding one currency equals to holding the cryptocurrency. Indulgently, we are going to be able to look at this quantity, which is expected currency return in that regard. Let me just talk about CBDC, and then I'm going to show you a few figures. Maybe I have 5 minutes, or yeah, about 5 minutes. Yeah, so the introduction of CBDC is modeled as a effortless cost. So if you want to introduce CBDC, you pay a flow cost for exerting the effort. That effort could be associated with coordinating existing institutions or experimenting with the technology, so on and so forth. But the benefit, the net benefit of introducing a digital version of the fiat to replace the fiat currency would be there is a jump from the original convenience flow to a higher convenience flow once the CBDC is developed. The development of CBDC arrives at a Poisson rate, exponentially distributed arrival. So that jump could be just, in terms of level, higher. It could also be related to how vibrant, how developed the crypto sector is. The idea is, well, if cryptocurrencies are more interesting, more functional, presumably CBDCs can take those functions as well. And as a government, we have to specify the government's or the central bank's objective. The objective can be generally specified as, I incur an effort cost in order to maximize a whole future path of something that's related to adoption as well as valuation of the currency, aggregate valuation. This delta just adjusts how focused the central bank is on the present versus the future. Right? That's something we can do some comparative statistics. In the model, because of the unit supply, prices and the adoption are going to have a one-to-one map. So in the end, it's essentially, one simple way to think about this is, I care about the valuation of the currency. I want to develop CBDC or digitize money in order to maximize a path of future valuations of the currency. So I'm going to show you some numerical results. One particular convenience flow form for holding currency X follows this Kara form. What that says is, if I'm not holding currency B at all, then holding marginally more, it gives me a lot of utility. We're talking about representative household, right? So there are some people who live in country B, so there's got to be some strong demand for currency B. It can be zero. So in terms of the impact on valuation, here horizontal axis can be viewed as the strength of the crypto sector, right? It's related to Y. For currency A, it's hurt uniformly. For currency B, if it has kind of this high inflation, it's a weaker currency, it's actually non-monotone. So the crypto directly competes with currency B, the weaker currency, but it also reduces the competition of currency A on currency B. So depending on which effect is more dominant, you can get non-monotone outcomes. In terms of the effects of CBDC issuance, this is the valuation of a particular currency after the introduction of its own digital currency. So for currency B, the benefit could be a lot bigger. That's why we were saying, the slightly weaker country could actually benefit a lot. In terms of the introduction of digital currency on cryptocurrency value, when they are introduced, it hurts cryptocurrency value, but the weaker country's introduction of digital currency hurts the crypto sector more because they interact with the crypto sector more in this when they are slightly weaker. Here's the pecking order of incentives for introducing digitized currencies. I just want to highlight this panel in the upper left. Basically, there are two picked incentives for currency A or country A to develop CBDC. The initial peak comes from, in the early days of crypto, if you introduce digital currency, it's going to kill the crypto sector. That prevents a lot of competition from crypto. But once it has gone to a certain scale, you can no longer kill it, right? Because the growth is endogenous. Then you actually don't mind having it there. You're still dominant. But eventually, the crypto sector is too developed. It triggers the digitization of currency B. And as a response to crypto sector and to digital currency B, the stronger country has to introduce their own digital currency. Basically, have to make it more efficient in terms of the convenience they generate. And okay, so let me just touch on one more thing. If the other country has introduced digital currency, is that prompt me to do more, accept more effort or less effort? It turns out that it's different for the stronger currency as opposed to the weaker currency. Basically, once A introduces digital currency, B loses incentive because they can become the first mover, and even after they introduce digital currency, A is still the dominant one, so they lose some incentive. But if B introduces digital currency, A actually has a non-monotone pattern in terms of the incentive to develop digital currency. When crypto sector is really small, or actually in the intermediate range, A has a lot of incentives because they also kind of manage to kill the crypto sector and also in response to B's challenge. But if crypto sector is really big, A actually loses some incentive. And when crypto sector is really small, A also cares less in this regard. So this is very much in the debate. And I think Daryl is going to be one of the speakers in the next session. There are different opinions on this, but we don't claim that, for example, China is introducing CBDC just to reach global dominance. We can't deny there's that possibility going forward, but that's not what the PBC is claiming. However, in terms of gaining regional competitive edge, because the household allocation does produce this convenience that has a locality to country A, currency A, country B. That's captured in the model to that extent. We can talk more about how this leads to different levels of innovation. I'll just mention one fact, and actually I'll stop there. One fact is there's actually an inertia in terms of financial innovation. If a currency is really strong, our model is going to produce a result that its incentive to digitize is actually pretty low because others haven't challenged them enough. Crypto sector or digital currency B are not challenging A sufficiently. So A wouldn't digitize, exert effort to digitize. It applies to this CBDC cryptocurrency setting. We can also think about a similar phenomenon. For example, the introduction of QR code payment, cashless payments. It's happening a lot in India, in China. It wasn't happening as fast in the US because the banking sector and the credit cards are working. So there's this interesting inertia captured in the dynamic setup as well. So finally, for the small open economy, depending on how weak the currency, the kind of the impact it receives from the rise or evolution of the crypto sector could be very different. The ones that are really weak, indicated by the super high inflation, when crypto sector is very small, it's actually benefiting a lot. But when the crypto sector is really big, eventually it's hurt by the crypto sector. And the small open economy in the early days, instead of developing their own CBDCs, they could potentially adopt a stable coin, but it can't be a stable coin pegged to the dollar, right? Again, they are subject to dollarization. So ideally, it's a kind of a basket of currencies or a consumption index that's going to work better. So with that, I'm going to stop here, and if there's question, I think we have a little bit of time, or
Yes.
The question is on price risk and market risk, right? So does the model also consider that? So one of the slides was the household allocation would increase, the yield is more, the returns are more, right?
Yeah.
But then the price risk of a crypto, for example, there's yield farming that gives you 60% to 20%. But the risk of that transaction is so much that I have not done it, for example. And as a household, I have not allocated. So does the model consider those things? Or?
Yeah, so I think the risk, in very reduced form way, if we think about the convenience, if suddenly it collapses, I lose the convenience. I think that can be partially reflected in the convenience flow, but it's not very explicitly captured. Yeah. Yes.
So how would you make a real difference? Do you make a difference between fiat currencies, because you may have countries in which payment cards are widely used, some countries in which contactless payments, for instance, are widely used, and I was wondering whether you could incorporate this feature in your model, because, for example, some colleagues have shown that when merchants start adopting contactless payment cards, so the paper is by Camera and
Yeah.
Houdini, then people start accepting more payment cards and start using more payment cards. So I was
Right.
wondering whether you could incorporate this feature in your model.
Yeah, no, that's definitely the case in empirically. Again, it's very reduced form in our setting. In terms of the convenience, if we allow the convenience coefficient to be higher, that could partially capture, there's already a very convenient network that people are paying it. And so that digitization, the jump in convenience after further digitization, maybe less than another country, which would benefit a lot from a jump in digitization. In our case, I think when we look at the jump after implementing a CBDC, we have this expression here. At the moment, these are taken as the same in the numerical plot, but if we take different constants for different countries, I think that can capture it in a reduced form way. Yeah. Thanks for the question. Yes?
I might have missed it, but I saw earlier you permitted the demand for the cryptocurrency to rise over time.
The convenience flow, the productivity, yeah.
It shifts
Demand,
the
yeah.
for, will you assume a constants abroad?
Yes. We kind of renormalize it to unit constantly. Not constantly, per DT period.
I guess where I'm coming from is, certain, like Bitcoin,
Yeah.
but I mean on the extensive margin.
Yeah.
I
Right.
potentially
So
a lot of entry and expansion into some way.
yeah,
It would be the whole crypto market.
yeah, yeah. So because we are using a representative household, so that's kind of captured, right? There's no difference. It's the same household. I guess intertemporally there's a
It's not a question about
yeah.
household, this is a question about the monetary policy of this third currency.
Yes.
Is it fixed or does it grow? That's all I'm asking.
It's fixed to unit supply.
I mean, it grows.
No, it's like the market. It's like the whole market. It's the market cap, the price.
Okay, I see what you're saying.
I'm not
Okay.
asking about the market cap. Of course the market cap.
Yeah.
grows.
It could grow.
Anyway,
Yeah.
I'm asking if the supply is growing.
Supply is fixed.
Yeah. Yeah. Supplies.
The question is.
Yeah.
Is that a concern? I mean, we're assuming that the countries are inflating, but I think there's a potential that we see this third currency also inflate. And would that change any of your results?
Okay. Great question. So the model is very stark in that sense, but I think it does capture this difference. If we think about at least the cryptocurrency, if you talk to the advocates, one feature that they would highlight is they use the word deflationary, which is not economically super accurate, but the idea is relative to what the government is doing in terms of printing more money or collecting more tax to run the infrastructure. In a decentralized, at least setup, there's less such collection and kind of big increase in supply that's going to lead to depreciation of the per token value. So here we did take a particular value on that. It's zero, but you are right. If we allow a relatively less inflationary or a term that's less influenced by currency A, for example, that would qualitatively it would be going in the same direction. Yeah. Thank you. Yeah, that's a great question. Yeah. Well, thank you very much.